Famed investor Jeremy Grantham describes 1980s Japan as the mother of all bubbles. As this bubble popped in 1990, it set a yet-to-be-beaten record for the highest price-to-earnings ratio ever recorded, approaching 100. Would you buy an entire stock market where stocks are trading at 100 times earnings? Some people did in Japan, 1990, and Jeremy shows the result here: decades of losses and pain. Jeremy also writes that the only thing that really matters in asset allocation is sidestepping some of the pain when the rare great bubbles break. At other times, traditional diversification will usually be good enough. If you are watching this, dear viewer, you are interested in avoiding getting caught in such a catastrophe. Japan's bubble was double trouble: extreme stock prices and extreme real estate prices. Let's start our account of Japan's bubble with its setting, the early 1980s. After World War II, the Japanese economy boomed continuously, turning Japan into an economic juggernaut and the world's second-largest economy by 1985. Yukio Noguchi writes that asset prices, including stocks and real estate, rose in the early 1980s alongside the booming Japanese economy. But he also notes that asset prices did not rise disproportionately until circa 1987, when both stocks and real estate prices decoupled from the real economy and took off violently. What caused this? Yukio Noguchi writes that the cause of the surge in asset prices was land speculation, enabled by changes in funding sources. In the late 1980s, Japanese corporations found it very cheap to raise money in the booming stock market. The raised funds were not all channeled into new industrial plants and equipment. A large proportion was used for what was called zai tech, or financial engineering, including buying financial assets offering high yields. Because large manufacturing corporations borrowed less money, Japanese banks faced difficulties to lend. Among the largest manufacturers, debt fell sharply from 59% to 34% of their financing need. Banks thus shifted lending away from large manufacturers. And thus, funds went into land speculation. In 1984, loans to the real estate industry amounted to only 27% of the volume for the manufacturing sector. But by the end of 1991, the balance had risen to 74%. Kunio Okina and colleagues agree. The rise in asset prices in Japan started around 1982, but 1987 is generally considered the beginning of the bubble period. They also note an explosion in money supply and credit, which rose five-fold, fueling both an overheating economy and asset speculation. The assets with the fastest rise initially were stocks, as the Nikkei 225 index shot up more than five-fold in 8 years and peaked at 38,000 in December 1989. Jeremy Grantham writes that the Japan bubble was the most extreme in human history, measured as of the Shiller-P ratio, which approached an incredible 100 in 1989. In comparison, other extreme bubbles such as .com in 2000 and 1929 crash were never valued at above 50 Shiller-P. The rise in land prices followed the stock market with a time lag, spreading from Tokyo to major cities such as Osaka and Nagoya, and then to other cities. The urban land price index peaked in September 1990, rising five-fold in the 1980s. The astonished press then reported that the grounds of Tokyo's Imperial Palace were estimated to be worth more than all real estate in California at the market peak. At the height of the Japan bubble, some financial pundits attempted to rationalize the astronomical valuations of Japanese stocks with all sorts of justifications, including accounting practices that understated profitability, and the Japanese cross-shareholding stability. These justifications are dangerous to individual investors who could falsely conclude that Japanese assets are different. The most dangerous phrase in investing is, "This time is different." But this time was not different. Yukio Noguchi writes that the beginning of the end of the Japan bubble was in May 1989, as monetary policy turned restrictive. In a cycle of 5 tightenings, the Bank of Japan increased the official discount rates from 2.5% to 6% in mid-1990. Long-term interest rates also rose. In this tightening process, a reduction of land prices was an acknowledged goal of financial policy. If the goal was to break the asset bubble, it worked. The stock market crashed first. The Nikkei 225 crashed 39% in 1990, 4% in 1991, and another 26% in 1992. And it took a very long time to come back. If you bought the top of the market in late 1989, you would not seen another peak for 35 years, in a cruel round trip even longer than the one seen in the US in 1929. The worst drawdown in Japan was a shocking 82%, almost as horrendous as 1929. So much for the advice on buying and holding forever. Commercial land prices saw a somehow similar fate, only worse. It spent the 1990s sliding every year, and by 21 the price levels were where they had started 20 years before. But unlike the Japanese stock market, the Japanese real estate market has yet to reach the peak it once saw in 1990. Will a peak ever be seen again? Yukio Noguchi explains that, when land prices fell throughout the 1990s, speculators found it impossible to resell as planned, and in many cases firms could not keep up their interest payments on the funds they had borrowed to make their purchases. This left banks with a large volume of non-performing loans on their portfolios. This bad debt problem would take decades to work out. Kunio Okina and colleagues explain that another negative consequence of Japan's bubble was the serious dynamic resource misallocation caused by misguided prices, in a mechanism that later led to slower economic growth. How did the Japanese economy perform in the aftermath of the bubble? It never went into a prolonged depression. Neither poverty nor economic hardship followed. But Japan's real GDP growth did slow down considerably from 1990 onwards, as shown here. Our verified sources are shown here. Write to us in the comments section if your interpretation is different, or if you'd like to suggest other sources. What are the takeaways for you? The first takeaway concerns Minsky and his anatomy of a bubble, which seems to describe the Japan bubble quite well. Euphoria set in Japan around 1987, as asset prices rose much faster than the economic fundamentals. The result for both stocks and real estate prices was the same: the bubble popped. Individual investors should exercise caution in the presence of spectacular price surges across entire asset classes. Another takeaway concerns the rationalizations that we typically see in bubbles. Back in 1989, the sell side or investment banks pushing Japanese stocks were glad to cite rationalizations, implying that Japanese stocks were not that expensive. We saw this again in the dot-com bubble in 2000, as the sell side claimed that profitability did not matter, only eyeballs did. You know better not to listen to the sell side. This time is never different. Thank you for watching. If you'd like to see more financial history, subscribe to our channel and join our community of individual investors who strive to learn from the misfortunes of others to avoid similar fates.